Hey everyone, and welcome. Today we're diving into a real economic mystery, one that has some of the smartest people in finance completely stumped. We're talking about the Japanese yen. It seems to be defying the laws of economic gravity, and we're going to try and figure out why.
So let's get right to it. What is going on with the yen? For months, its value has been in a total nosedive. But here's the weird part. Everything you read in the textbooks, all the conventional wisdom says it should be getting stronger right now. So, what gives?
And this, right here, is the core of the whole puzzle. Look, on one hand, you've got the rulebook. Economic Theory 101. A country raises interest rates, its currency gets stronger. Simple. But then you look at what's actually happening in Japan, and it's the complete opposite. This contradiction is exactly what we need to unpack.
To get to the bottom of this, we've got to look at two very different stories. First, there's the official narrative coming from the Bank of Japan. And then there are the cold, hard facts of what's happening to people's wallets on the ground.
So what's the official story? Well, the central bank is basically saying, whoa, hold on a minute. They're worried that with wages going up, people who've been saving their money are about to go on a massive shopping spree. All this pent-up demand, they say, could cause the whole economy to overheat. Sounds plausible, right?
Right, but is that really what's happening? This is where our detective work really begins, because when you look at the actual numbers, well, they tell a totally different story.
Okay, so wages might technically be going up a bit on paper, but here's the kicker. Once you account for inflation, the rising cost of pretty much everything, the average family in Japan actually has less money to spend. Their real buying power has dropped by a whopping 2.5%.
And you can see exactly what that means right here. Instead of that huge spending boom the central bank was so worried about, household spending has totally cratered. People feel poor, so they're doing what you'd expect. They're tightening their belts and spending less, not more.
So if the official inflation story is kind of falling apart, what's the real play here? Is there something else going on behind closed doors at the Bank of Japan? Maybe a hidden motive?
And this is where it gets really fascinating. Some analysts suggest a major plot twist. The Bank of Japan's true goal was never really about managing inflation at home. The real target was the yen itself.
The playbook was pretty straightforward. Step 1, talk really tough about inflation, make it sound like you're about to hike interest rates. Step 2, that tough talk pushes up the returns on your government bonds, making them look super attractive to investors. And the end goal, step 3, all that foreign money comes flooding in, which in theory makes the yen stronger and brings down the cost of important stuff like food and energy.
And this whole plan hinges on a key idea called the interest rate differential. It's actually pretty simple. Money is always looking for the best return, right? So if Japan offers a better interest rate than, say, the US, capital should flow into Japan. More demand for yen means a stronger yen. It's classic economics.
But yeah, look at this. The theory just didn't hold up in the real world. As you can see, even when the numbers, that key interest rate differential, started looking better and better for Japan, the yen didn't get stronger. Nope, it just kept getting weaker and weaker still.
I mean, this wasn't just a little bit off. The plan completely spectacularly backfired. It went in the exact opposite direction of what the textbook said should happen. It's like gravity just suddenly decided to stop working.
Okay, so if the central bank's big plan was a bust and the classic theories aren't working, what's the real culprit here? What's the hidden force that's actually pulling the strings on the yen?
The answer, it seems, isn't in Tokyo at all. It's found in the massive, tangled web of the global financial system. We're talking about a force so big, so interconnected, that it operates way beyond the control of any one country's central bank.
So let's trace the real chain reaction. It all starts with households, not just in Japan but all over the world, feeling the financial pinch. That's a huge red flag signaling a global economic slowdown. In response, the whole global financial system starts to tighten up. And when the world market gets nervous, where does money run for safety? To the US dollar. The dollar gets stronger. And because currencies are like a seesaw, a stronger dollar just automatically pushes the yen down.
And this is where the story gets really important for all of us. This isn't just about currency exchange rates. What's happening in Japan, it's a warning shot. It's the proverbial canary in the coal mine for the entire global economy.
See, the key thing to realize is this. The financial pain that Japanese households are feeling, it's not a uniquely Japanese problem. It's a mirror. It's reflecting a global downturn that's hitting everywhere, all at once. The exact same pressures are building up in major economies all over the world right now.
All right, so let's boil this whole mystery down to the four most important takeaways. First, forget what the old textbooks say about interest rates and currencies. The game is clearly changed. Second, the Bank of Japan tried to play that old game to boost the yen, and it just didn't work. Third, the yen's weakness isn't really about Japan, it's a symptom of a much larger issue, a creeping global recession. And finally, and this is the big one, the hardship people are feeling in Japan is a preview of what could be coming for the rest of us.
So that leaves us with a pretty massive and honestly kind of unsettling question. If the people we thought were driving the bus, the central bankers, don't actually have their hands on the wheel anymore, then who does? And where is this global economy of ours really heading?